Welcome to the weekly market recap. Today is Sunday, July 19, 2026. Ouch. Talk about an icy wake-up call for the bulls this week. The U.S. stock market took a noticeable step backward, breaking its consecutive weekly winning streaks. The S&P 500 fell about 1%, marking its first losing week in the last three and only its third negative week since the end of March. Just a couple of days ago, we were coasting beautifully within 0.5% of all-time highs, but things turned sour incredibly fast. What exactly triggered this sudden flip in sentiment? It was a nasty double whammy, an absolute reality check for bloated artificial intelligence valuations colliding head-on with a massive geopolitical flare-up in the Middle East. Tech investors decided it was time to lock in their massive profits, while energy traders frantically hit the buy button as an escalating conflict with Iran disrupted critical global shipping lanes. When we look under the hood at sector performance this week, it was a total game of musical chairs. The technology and semiconductor sectors, which have been absolutely carrying the entire market on their backs all year long, suffered a brutal liquidation. Chip stocks and AI darlings were at the absolute epicenter of the shaky trading, driven by growing anxieties that the massive multi-billion-dollar capital expenditures for AI infrastructure aren't going to turn into actual corporate productivity and profits anytime soon. On the completely opposite side of the floor, the energy sector was the undisputed king of the week. With West Texas Intermediate crude oil skyrocketing, energy stocks became the ultimate safe haven for rotating capital, driven by the massive oil supply disruptions. Remember when everyone was drunk on absolute market optimism just a couple of weeks ago?
Yeah.
That party has officially been broken up by the cops. The Fear and Greed Index has plunged down into a chilly 37, pushing us firmly into fear territory. Investors have shifted instantly from FOMO, fear of missing out, to pure self-preservation. Volatility is creeping back into the market playground as institutional traders aggressively de-risk and reevaluate their portfolios ahead of the upcoming tsunami of Q2 earnings reports. Our top macro story of the week is a heavy one that sent shockwaves through global commodities. Geopolitical tensions in the Middle East reached a dangerous boiling point after a heavy exchange of military attacks between the United States and Iran. This led to 6 consecutive days of strikes that severely limited commercial tanker traffic through the ultra-critical Strait of Hormuz. Because of these severe supply disruption risks, West Texas Intermediate crude oil surged by a jaw-dropping 14% over the course of the week, hitting its highest levels since mid-June. This massive energy spike has instantly reignited fears of a secondary inflation wave, completely overshadowing some otherwise fantastic domestic economic data and forcing macro hedge funds to pivot their strategies overnight. Our second major story hits right at the core of the tech bull market. The multi-trillion-dollar artificial intelligence secular growth story faced its harshest structural scrutiny yet. It all kicked off when semiconductor giant Taiwan Semiconductor posted a massive beat-and-raise quarter, but then announced plans to aggressively increase its capital spending. Instead of cheering, investors panicked, worrying that these astronomical infrastructure investments might take years to yield a real return on investment. Compounding the tech anxiety, reports emerged that Google parent Alphabet is months behind schedule in rolling out its latest highly anticipated AI model. To top it all off, Chinese startup Moonshot AI unveiled its new open-weight model, Kimi K3, proving that open-source competition can rival the big tech giants at a mere fraction of the cost. Coming in at number 3 is a fascinatingly mixed bag of domestic economic data that left economists scratching their heads. On one hand, the Department of Labor reported that both the Consumer Price Index and Producer Price Index came in cooler than expected, which normally would send stocks straight to the moon by reducing the probability of future Federal Reserve rate hikes. However, other data showed a hyper-resilient economy that isn't slowing down at all. The Empire State Manufacturing Index rose to 15.6, while the Philadelphia Fed Index absolutely exploded to 41.4, completely blowing past the consensus estimate of 13. This massive jump in business conditions and employment proves the underlying economy is still running incredibly hot, creating a massive structural pull and push for monetary policy. First up in our S&P 500 spotlight is none other than NVIDIA, ticker NVDA. Talk about a wild, stomach-churning ride. NVIDIA was the heaviest single anchor dragging down the broader index this week, culminating in a steep 2.2% drop on Friday. The stock has been under immense pressure as institutional investors aggressively rotate out of crowded tech names due to fears that demand for AI chips might be hitting a temporary macro wall. In fact, the Friday tech rout was so intense that Nvidia briefly ceded its #1 ranking as the most valuable company on Wall Street to Apple before managing to claw its way back up by the closing bell. NVDA is experiencing some serious valuation vertigo right now, and every single move it makes is sending shockwaves through the entire market. Next up is Micron Technology, ticker MU, and it was an absolute bloodbath of a week for the memory chip giant. Micron finished the week down a painful 10% as a massive wave of profit-taking swept through crowded semiconductor positions. Institutional traders completely flipped their scripts on MU overnight, moving from unbridled excitement over high-bandwidth memory demand to aggressive risk-off liquidation. The stock experienced brutal, volatile, intraday swings, at one point fluctuating between a 5.8% loss and a 3.2% gain in a single morning session. When a massive mega-cap stock starts moving with the volatility of a penny stock, you know the big institutions are panicking and violently rebalancing their portfolios. Rounding out our S&P 500 trio is Apple, ticker AAPL, which stood out as a spectacular green oasis in a massive desert of red tech stocks. Apple completely bucked the bleeding semiconductor trend, climbing an impressive 5.4% over the week and hitting a brand new 52-week high at $333.26, while everyone else was fleeing microchips and software companies. Big money aggressively piled into Apple as a defensive tech safe haven. Investors are betting heavily on Apple's massive fortress balance sheet, its multi-billion-dollar cash reserves, and its incredibly sticky consumer ecosystem. Apple's steady gains prove that even during a tech rout, institutional money doesn't always exit technology entirely. It just rotates into high-quality cash flow monsters. Moving down to the small and mid-cap arena, the pain in the technology ecosystem was amplified tenfold. SanDisk, ticker SNDK, was the ultimate casualty of the week, plummeting by an astonishing 24%. Small-cap tech companies completely lack the massive financial cushions and diversified revenue streams of their mega-cap siblings, making them incredibly vulnerable when market sentiment turns sour. As concerns over international AI chip competition grew and global flash memory pricing power faced sudden structural skepticism, retail and institutional traders completely abandoned ship, triggering a massive high-volume technical breakdown on the weekly chart. On the completely opposite side of the spectrum, small-cap energy players had an absolute field day this week. Peabody Energy, ticker BTU, became one of the top trendy gainers on the market as global energy desks scrambled the price in the Middle East shipping crisis. While crude oil gets all the flashy mainstream headlines, traditional power generation alternatives like thermal coal surged right alongside it. Peabody stock saw massive institutional buying volume as macro funds actively hunted for small cap names with dirt cheap valuations that would benefit directly from a sustained global commodity shock. It was a classic example of old school energy completely outperforming tech. To wrap up our small cap coverage, we have to look at the regional banking sector, ticker KRE. Small banks were caught in an absolute thematic tug of war this week. On one side, the cooler than expected CPI and PPI inflation data signaled that regional banks might finally get some massive relief from high deposit costs as future Fed rate hike fears rapidly subside. On the other side, the explosive manufacturing data from the Philly Fed raised worries that long-term yields might stay higher for longer, threatening their loan books. This left regional bank stocks highly volatile and churning sideways, proving that small caps are hypersensitive to every single piece of conflicting economic.
Let's pull up the weekly frames and look at the critical technical lines in the sand, starting with the SPY. On the weekly chart, the S&P 500 ETF printed a highly visible bearish engulfing candle after completely failing to sustain its breakout above the 560 level. For the upcoming trading week, your absolute critical line in the sand for macro support sits right at the 5,450 to 5,400 zone, which perfectly aligns with previous structural demand and buyers stepping in.
On the upside, major overhead resistance is firmly locked at 5,600. If the bulls fail to defend the 5,400 level on a weekly closing basis, expect a much deeper correction down toward 5,320. Next up is the tech-heavy NASDAQ 100 ETF, ticker QQQ, and this chart looks the most fundamentally damaged. The QQQ broke decisively below its short-term exponential moving averages on the weekly frame, signaling that short-term momentum has officially shifted into the hands of the sellers. Critical macro support now rests at the 470 psychological level. If that structural area fails to hold, the floodgates could open quickly for a drop down to 455. To regain absolute control, the tech bulls have a massive mountain to climb with heavy, thick overhead resistance waiting impatiently at 495 and 500. Finally, let's look at the small cap captain, the Russell 2000 ETF, ticker IWM. Small caps have been consolidating inside a giant multi-month horizontal range, and this week's wild macro action kept them stuck right in the dead center of it. Macro support on the weekly chart is beautifully well defined at the 210 level, which has acted as an absolute hard floor for buyers for several months now. On the flip side, strong overhead resistance is capping all near-term gains at 225. Until IWM can decisively break out of this 210.25 box on massive institutional volume, expect continued choppy, range-bound trading. Shifting gears to the digital asset space, Bitcoin put on an absolute masterclass in structural resilience this week. Despite the chaotic risk-off sentiment hitting traditional global equity markets, BTC managed to hold its ground remarkably well, fluctuating tightly between the $63,000 and $64,000 price range. Fascinating on-chain data revealed that Bitcoin whales are actively moving billions of dollars, completely absorbing the macro sell-off and accumulating heavily during every single minor drawdown. From a technical standpoint, key weekly support is firmly established at $62,000, while the bulls face immediate horizontal resistance at $65,000. A clean breakout above $65,000 could spark a massive short squeeze. Ethereum followed Bitcoin's resilient lead, but traded with slightly higher historical volatility, consolidating right around the $3,350 mark. Crypto investors are closely watching the 3,200 and 2,000 support level on the weekly frame, which has successfully defended against multiple heavy bearish attacks over the past month. Overhead technical resistance is currently stacked incredibly thick at $3,550 and $3,600. If Ethereum can cleanly clear that overhead supply, it will officially validate a long-term bullish accumulation base, paving the way for a powerful rally back toward its all-time highs later this summer. As for the broader altcoin market, it was a much tougher, more painful story. Total altcoin market capitalization significantly underperformed both Bitcoin and Ethereum this week, as liquidity was systematically drained out of riskier, high-beta digital assets. With the market fear and greed index sitting down at a nervous 37, retail traders simply didn't have the stomach to hold highly volatile small-cap tokens. Most major altcoins suffered moderate losses across the board, proving once again that when macro fears spike and global energy prices surge, capital rapidly flees the speculative fringes of crypto and rushes straight back into digital gold. As we officially put a wrap on the week, the overarching market sentiment can be summed up in one word: defensive. The explosive mix of geopolitical conflict and AI valuation anxiety has forced big money to de-risk. However, don't count out the bulls just yet. Underlying corporate earnings are tracking exceptionally well, with 95% of reporting S&P 500 companies beating bottom-line estimates so far. Looking ahead to next week, all eyes will be on Alphabet's highly anticipated earnings report on Wednesday, which will serve as the ultimate litmus test for AI capital expenditure guidance. We also have critical macro data dropping, including EIA crude oil inventories on Wednesday, initial unemployment claims on Thursday, and new home sales on Friday. Buckle up, because the volatility is far from over. If you enjoyed this breakdown, make sure to hit that like button and subscribe to the channel for more weekly market recaps. See you next week.